income is in the seven figures, this video is for you. Because when you cross that $1 million line, how you earn your income matters just as much as how much you earn. Under the big beautiful tax bill, the difference between a 30% tax hit and a 28% effective rate often come down to timing when your bonuses, stock option, and deferred compensation are recognized. So in this video, we are going to break down 6 key points step by step that will help you master the millionaire's playbook for executive compensation. Here's the roadmap for today. Part 1. What changed under TOB3 and why it matters to high earner. Part 2. Some client story, how an executive saved over $30,000 just by timing her pay. Part 3. The 2025 action checklist. For tax year 2025, what to do now before the window closes. Part 4, planning beyond 2026, how to future-proof your income strategy. Part 5, a bonus section for founders and private company executives, how to structure your equity and qualify for tax-free gain. Part 6, a final recap to help you design your income calendar for smarter wealth building. So stay with me until the end. This video could easily save you 6 figures in unnecessary taxes. Let's start with the big picture, what's new and why it matters. TOB3 didn't overhaul where wages were taxed, but it did lock in extended tax brackets, a larger standard deduction, and temporary stable top rate through 2026. Here, what that means for $1 million earners, you have roughly a 2-year window to plan your compensation timing before possible change in return after 2026. Now, let's talk about the 3 most relevant updates for executive and founders. First, the standard deduction is now $31,500 for a married filer in 2025. Meaning you can offset more income at lower effective rates. Second, Section 409A, the deferred compensation rulebook remains strict, but with clarity around advanced elections. That means if you plan early enough, you can delay when income becomes taxable without violating IRS timing rules. Third, the 83B election is still one of the most powerful tools for private company executive. It lets you pay tax on restricted stock now when value is low, so all future appreciation can be taxed at capital gain. But remember, this applies to restricted stock, not RSUs. RSUs are taxed when they vest, unless they qualify under Section 83I for a special 5-year deferral. So, right here in Part 1, the big idea is this. You can't control the tax rate, but you can control when your income is recognized. So TOB3 gives you that breathing room if you plan before the calendar closes. So theory is great, but let's now make it more concrete with an example. So in Part 2, I want to take you to a client scenario so you can see how this move play out in real situation. So let's talk about Lauren's biotech bonus plan. So meet Lauren, a biotech executive in Boston. She earns $600K in base salary and about $500K in bonuses and stock each year. So that putting her at the $1.1 million in annual income. Now, let's say it's early 2025, so Lauren's company had just granted her restricted stock awards and RSUs that would vest evenly starting in 2026. Sound organized, right? Except there was a hidden problem. Her stock was set to vest after the current lower tax bracket window, potentially costing her an extra 6 figures in tax. So here, what she could do step by step. Step 1, you can identify that part of her grant was restricted stock, not RSUs, meaning we could use Section 83B election. We file within 30 days, paying tax on roughly $80K of value in 2025 while rate was still compressed. Next, we look at her bonus timing because her income, her company deferred compensation plan was compliant under Section 4098. She had the option to shift her 2025 bonus paying out to January 2026. That meant the income would fall in the following tax year, a perfect pairing with her large charitable foundation donation that same year. Step 3, finally, we map her option exercises to align with deductions. Her plan allowed incentive stock option, so she exercised in 2026 when her AGI was lower, avoiding the AMT trigger and capturing capital gain treatment on future growth. The result, about $82,000 in combined tax saving plus long-term capital gain potential on her equity. Lauren takeaway after seeing her tax plan: same pay, different calendar, better outcome. Now that you have seen how Lauren did it, let's walk through how you can do the same. In part 3, I will give you your 2025 millionaire compensation checklist and a must-do before the window closes. This part is your action list, what you should be doing now to lower your future tax bill. Before we start, remember, this video is for high-income owner, executive, entrepreneur, and anyone with complex compensation. If you make over $1 million and your income includes stock, bonuses, or performance pay, this is for you. Let's go step by step. Step 1, run a 2-year tax projection. Sit down with your CPA and model 2025 and 2026 side by side. Look at when each income event hits, like when bonus, vesting, stock sale, and run the number. Sometimes accelerating income saves tax. Sometimes deferring it does, but you will never know unless you model both. Step 2, file 83B election early. If you receive restricted stock in 2025, file that election within 30 days. Don't wait. If you miss the window, it's gone forever. By recognizing income now while the value is low, you start a capital gain clock immediately. Step 3, coordinate bonuses with deduction. This is where charitable planning shines. If you plan to fund a donor advised fund or make large gifts, do it in the same year your bonuses hit. If your company let you defer your bonus under 4098 compliant plan, that's another way to match income with deductions. Step 4, review deferred compensation plan if HR. If your plan allows you to elect 2026 payout during late 2025. If yes, make this election before year end. You can change it retroactively. Step 5, diversify income types. If you are heavily concentrated in wages, consider shifting some income to capital gains through equity sales or investment. Diversification isn't just about risk, it's about rate management. Pause for a second and think, if you're in that 1 million plus income bracket, which of these 5 steps can you act on this quarter? Write it down. The earlier you start, the more control you will have by year end. Okay, so we have optimized 2025, but what about after? So part 4 is where we look beyond the immediate window, how to build resilience into your compensation strategy through 2026 and beyond. Even though TLB3 made many TCJA era cuts permanent, not all of them are guaranteed forever. The political and economic landscape can change, so treat this as a 2-year planning runway. Here's how to prepare. First, exercise stock options early. If you have incentive or non-qualified stock option, consider exercising while valuations are reasonable. Early exercise trigger lower taxable income and start your capital gain clock earlier. 2. Stack deductions in the same year you recognize income. When you expect a large income event like a stock sale, plan your deduction that same year. This includes donor advisor funds, mortgage interest, and retirement plan contributions. And remember, in our other video, we were talking about real estate professional status. So if your spouse can qualify for that, then you can unleash a lot of the capital passive gain, passive loss from paper loss like depreciation to offset your W-2 income, like your active income. So refer to the previous video we did. 3. Can your income dip for Roth conversion? So if your income temporarily drop, say because you defer a bonus, fill that space with a Roth conversion. You will pay tax in a lower bracket and lock in tax-free growth. 4. Negotiate flexibility, not just pay. When you renew or sign a new contract, negotiate the timing levels, how bonuses are paid, how stock vests, and whether you can defer compensation. So the smarter owner know flexibility is worth more than a higher salary. It's not about predicting tax law, it's about being ready for any version of it. You can't control Congress, but you can control your income calendar. Now for the entrepreneurs and founders, watching this next section is your bonus. We are talking about private equity, company equity, so QSBS, and the once in a decade opportunity to make millions tax-free. So under Big Beautiful Tax Bill, Section 1202, that's qualified small business stock got supercharged. Here's what it means for you if you own or plan to own shares in a C corporation. Hold the stock for 3 years, and you can exclude 50% of the gain. Hold it for 4 years, that jump to 75%. In 5 years, it's 100% tax-free, up to $15 million per issuer, and the company can now have up to $75 million in gross assets and still qualify. Let's look at the story that shows how powerful this is. So David, a Seattle tech founder, incorporated his AI startup as a C corporation in mid-2025, right after TLB3 passed. We help him structure the share so he can qualify for QSBS from day one. He held into his stock through 2030 when the company was acquired for $20 million. $15 million of that gain were completely excluded from federal tax. Now here's the twist. Before the sale, David gifted a portion of his share to a trust for his children. The trust qualified for its own $15 million exclusion, multiplying the benefit. That's not a loophole, that's more structuring under the law. So if you are a startup, founder, executive, or early investor, this is your wake-up call. Don't wait until after funding rounds to get your corporate structure review before the shares appreciate. And for RSUs, remember, they don't qualify for 83B, but they may qualify for 83I if you work for a eligible startup. That deferral can push your tax bill up to 5 years past vesting, but the election must be filed correctly and within the required time frame. We have covered a lot, from timing W-2 income and bonuses to stock election and private equity strategies. Now, let's put it all together in the final section, your personal millionaire tax playbook. So let's recap what we covered today. In part 1, we discussed how TLB3 kept rate favorable through 2026 and how timing now matters more than ever. Part 2, we walked through Lawrence Biotech case, showing how early election and deferred bonuses save over 80K. Part 3, you got your 5-step checklist for 2025, projection, 83B, bonus timing, deferral review, and income diversification. Part 4, we cover long-term planning, exercising options, stacking deduction, and negotiating smarter contracts. Part 5, we finish with the big one, which is private company equity and QSBS, where gain can literally become tax-free. Now, here's the bottom line. The wealthy don't just work harder, they schedule smarter. Every bonuses, every vesting day, every sale can be designed to happen in your best tax year, not your worst. The big beautiful tax bill didn't eliminate taxes on high earner. It gave them a 2-year window to redesign their income around lower effective rates, expanded deduction, and flexible recognition rules. So if you are earning 7 figures, don't wait for tax season to decide your fate. Plan it now, time it deliberately, and make your income calendar work as intelligently as you do. That's how $1 million earner turn compensation into strategy under TLB3. Thank you for watching. I'm Mia, and I will see you at the next video update.